it's very important, and he has actually mentioned the critical issues in the areas of the drivers of that demand and supply, and how the extent of the helplessness, I don't want to use that word really, the extent of the capacity of the CBN to involve. I think from an analyst perspective, what I would like to add to it is to begin to dig down to what is the fundamental drivers of the disparities we are seeing between those three rates you mentioned: the official market, the interbank, which is the free market, as well as the reducing market, which is mirroring the parallel market. One fundamental part of the policy of the CBN in relation to exchanges is to ensure that the gap, what we call spread, between each of these rates is as limited as possible. The goal is actually to keep it below 2%. Because the wider this gap is, the more the incentives for what we call an arbitraging to be going on in the system. You can recall the days of what we call round tripping. And when you have these days, it keeps significant and continuous pressure on what is the official rate, as long as that gap is there. Because people can take a cheaper rate from the official and begin to take to this other market and making cheaper profit, doing anything, and continue to put the pressure until the rate is pushed, which is what we call, it is not real, it is fake, it is not transaction driven, and it's very, very disruptive to an economy. However, there is a global challenge that is driving the current issue in relation to the volatility of the naira, and the reason why this monetary authority, the CBN, cannot just fold his arm and be looking.
Yeah, because I was wondering what would happen if the CBN stops intervening in the market.
Let me just explain a bit. In 2011, 2012, one of the issue that was on the table like now is the pressure on the foreign reserve. And the monetary authority at that time, in its wisdom, decided that, look, let us begin to allow more of autonomous flow into the system to support our continuous support so that there will be reduction. As Mr. Idoza has mentioned, one thing that could happen is for more autonomous, such that the CBN can reduce how much it supports the market with. Now, what did it do? It began to encourage what we call foreign portfolio investment flow into Nigeria, what we call hot money. How did it do that? It first of all removed the restriction on how much of Nigerian assets in terms of tenure bond that foreign investors can invest in. Before, we had the restriction: if you are bringing your money as a foreign investor, you can't buy more than a year tenure worth of bond, as in terms of maturity. But the CBN expanded that to include every range, and then it expressed its commitment to keep the naira strong. It expressed its commitment to ensure that the yield on bond is very high. And what did we see? There is a massive inflow of foreign portfolio investment to Nigeria. Right now, in 2013 alone, we saw about $16 billion flow into both bond and equity market. And this money about 21% growth in just 11 months. And these are money, and what did it do? It supported the stability that we saw in 2013 of for the exchange rate. During that year, you will realize that between the beginning of the end to the end, naira was really relatively stable in all of this market until when we introduced the RDAS toward the end of the year. And right now, we are sitting on top of about $16 billion of foreign portfolio investments in equities and bond. At any point in time that you have any risk to the economy, these guys are going to move their money.
Now that brings me to this.
Now, what we have seen in recent time, let me just move it to the end, then we can. What we have seen in recent time is a situation where the developed economy are trying to reduce what we call their quantitative easing, easy money to ensure their own economic growth, following the depression we've seen in the past. And that reduction, for instance, America is reducing its own by $10 billion every month. And what we have seen, the repricing of risks by these foreign investors mean they can move their money back. There are projections that these developed economies are going to grow stronger this year, while emerging economies are likely to suffer because of the capital flow or capital reversals that will follow it. All this money that flew to us were borrowed at 0%. If interest rate rise in those economies, these guys are going to be paying more. So they have to go back before they got caught. So if you look at January to now, there are peers. That's what we call the fragile five. The fragile five emerging economies. You have Brazil, India, Indonesia, South Africa, and Turkey. these economies have sustained the massive erosion of their foreign exchange during this period, because those are where money flew out so much that they've had to increase their benchmark rates to support or reduce this outflow. Nigeria have not really witnessed that kind of whatever. Why? Because the CBN has been supporting the Naira massively. Even if you notice this period, we've moved from selling an average of, say, $250 to $260 million per auction to $400 million per auction. That was before the announcement of Sanusi suspension. And we've also seen all these rate moves. So at the bottom of this whole analysis is a global dynamics in capital flow, especially from emerging market back to developed economy, that is driving the pressure on foreign exchange. And in all fairness, if you compare relatively with our peers, Nigeria may not really have been doing badly in relation to what our exchange rate is. However, the price for that is our foreign reserve.
Well, Mr. Idahosa, with all of what Mr. Dola has spoken about, and with what we saw happen just in the last 2 days of last week, when the news of the suspension of CBN Governor Sanusi Lamido Sanusi hit the market, the Bank of America immediately downgraded Naira-linked instruments, and its reason was that it was afraid of a further value hemorrhage in the market, and this put more pressure on the Naira. But what does this actually mean?
Well, the suspension is an event. It's come and gone. But the Bank of America is looking at the trends over the past 6 months, 9 months, 1 year. What have we been seeing?
But what happened on Thursday and Friday actually brought that to a head.
It brought it out, but the Bank of America and everybody else is saying that if this continues and is likely to continue, then we are going to see a gradual erosion of the midpoint of whatever CBN can do. In other words, CBN might be forced to move from 155 to a higher point. So that is the reason why everyone, like the Bank of America, is beginning to feel worried. If our excess crude account, for example, was rising, if our foreign reserves were rising, and Sanusi was suspended, no one will worry. But that, anything really wrong will happen. Wrong in the sense of moving against our interests. But the fact that the trend has continued consistently, that our foreign reserves have been going down, one of the major buffers we have, our excess crude account, down from 22 billion to less than 2 billion over this same time frame. It means that anyone that is looking at the trend will be concerned that it's going to continue unless some big things happen.
Yeah, but you know that when the acting CBN Governor, Dr. Sarah Ade, had her first media briefing on Friday, she actually mentioned that status quo would remain and there wouldn't be any change whatsoever. That ought to have allayed the fears of investors, but because we still saw that the pressure on the Naira continued even after that piece of news.
I don't think so, Eric. I don't think so. Like I said, there is almost what I would call a fixed situation with what I just described in relation to the emerging market hemorrhaging. So there is really little we can do about that right now.
Okay, so the situation is practically out of our hands.
Out of our hand, except the CBN continue to support the Naira, and hoping that we remain, our risk profile remain reasonably attractive enough to sustain what is around and perhaps bring more.
But you see, we're supporting this market. Sorry to cut you here. We're supporting this market to the detriment of our reserves.
That's what reserves is meant to do. That is what reserve is meant to do. We shouldn't make any mistakes about the fact that the reserves used for these things are negative in its frame. The most important thing is, like Mr. Idahosa pointed out, there's a level where it's supposed to become a problem. And at that level, we should have concern. Immediately we drop below 6 months. In fact, 6 months is even a second level of worry. Is the first level of worry. The biggest level of worry is when we drop to 3%. 3 months import capacity. Now we are at around 7 months of import capacity. The fact that it's coming down should be a source of worry. But technically, what reserves are meant for is to support your capacity to balance your balance of payments and management through your exchange rate management process. So you don't use the money for any other thing to a large extent. There are other things. You hold international assets, hedging, ensure you have all this money so that when the need arises, you can always bring them out to do this thing. So the reserve is serving its purpose. Where you have issue is the excess crude account, which is our buffer for the economy in terms of spending. So now the excess crude has now is almost depleted, and that creates a risk profile for the economy in itself. So in the recent survey, that is what the reserve is meant to really serve. And where I was coming from before you interrupted was that there's a basic a status quo that is already driving, that's already putting pressure on the naira exchange rate, which is the global emerging markets capital outflow back into to the developed economy. And the CBN is not doing badly at ensuring that we are at least reasonably stable with this. And if you have $16 billion hot money in your system, what I used to do when I do my analysis is to actually remove this from what our foreign reserve is at any point in time and say adjusted foreign reserve. 16 billion out of 40 is perhaps going to take us to like around 5 or 6 months of import, assuming we see all this money leaves right now. If anybody who owns FPI in Nigeria say, I'm taking my money away and I'm not sure what you guys are doing, please, I want to sell my equities, I want to sell my bond, and I'm repatriating back to my country, and I'm demanding for dollar immediately. That put a lot of pressure. In fact, $4 billion could create problem for Nigeria if they want to leave immediately. True. Well, but if you can manage it, it's fine. But the risk is there. I'm not trying to downplay the risk. But I'm saying that to a large extent, that pressure is there from a global pressure point.